What if I told you two people invest the same $10,000 for 30 years, one ends up getting paid every single month like a salary in retirement, and the other ends up with more total wealth on paper, but has to sell pieces of their portfolio just to survive, and the strange part is, both of them look completely successful, right up until the day they actually retire. Don't forget to like the video and subscribe to the channel so you don't miss the next video. Let's make this real example with actual numbers instead of just theory. Imagine two investors. Both start with $10,000. Both invest for 30 years. But they take two completely different paths. The first investor builds a dividend portfolio. Let's say their money compounds at an average of 7% a year. After 30 years, that $10,000 grows to around $76,000. Now here's the part that feels good. Their portfolio pays an average dividend yield of 3.5%. That works out to about $2,600 a year, or roughly $220 a month, arriving automatically. No selling. No decisions. The money just shows up. The second investor puts the same $10,000 into a simple index fund and never touches it. Because index funds reinvest everything automatically and carry almost no fees, their money compounds faster, let's say 8% a year. After 30 years, that same $10,000 grows to just over $100,000. But there's a catch. Index funds don't pay you anything directly. So in retirement, this investor uses something called the 4% rule. A withdrawal strategy that lets you pull out 4% of your portfolio each year with a very low risk of running out of money over 30 years. 4% of $100,000 is about $4,000 a year, or roughly $335 a month. So mathematically, the index investor ends up with more total wealth and more monthly income. That's the part most people don't expect. If this is starting to make sense, go ahead and like the video and subscribe. It genuinely helps more people find these simple, no confusion breakdowns of investing. So if index funds come out ahead on the math, why does anyone choose dividends at all? Because getting that $335 a month means selling shares. And the dividend investor's $220 a month means doing nothing at all. Now picture both of them retiring right into a bad market year. The market drops 20%. The dividend investor still gets paid. The payout might shrink a little if a company cuts its dividend, but the cash keeps showing up every quarter, regardless of what the account balance says. The index investor watches their $100,000 portfolio drop to $80,000, and still has to sell shares every month to live. Selling into a falling market doesn't just feel uncomfortable. It's also when investors are most likely to lock in losses they can never recover from. That's called sequence of returns risk, and it's one of the most underestimated dangers in retirement planning. That's the moment panic usually begins. Not because either strategy is wrong, but because one of them feels completely different from the other when things get rough. So here's the actual trade-off, stripped down to one sentence. One system is built for stable income today, and the other is built for maximum total wealth with flexible withdrawals. Index funds win on the numbers, higher long-term growth, lower fees, better diversification, and stronger compounding, simply because nothing gets pulled out along the way. Dividend investing wins somewhere else entirely, psychological comfort. A stable feeling. No selling decisions. Less stress when the market is falling apart. And that second category matters more than most people admit, because the biggest reason investors fail isn't bad math. It's bad behavior. Panic selling during a crash, abandoning a plan out of fear, or chasing a tempting high yield from a company that's quietly struggling, those decisions wreck more retirements than any spreadsheet ever could. So the real question was never, which strategy is better? It's, which system can actually survive your emotions for 30 straight years? Because here's a truth nobody likes to hear. A perfect strategy you abandon halfway through is worse than an average strategy you actually stick with. That's exactly why a lot of real investors stop picking sides. They build both into one plan, index funds for long-term growth, and a slice of dividend-paying assets for the emotional stability of seeing cash show up no matter what the market is doing. One part grows quietly in the background. The other part pays you just often enough that you never feel tempted to panic. In the end, retirement success was never really about who had the bigger number on paper. It's about who could actually stay invested long enough to get there. If you enjoyed this video, like it and subscribe to the channel for upcoming simple explanations videos.